Hi guys, welcome back to my channel. I finally graduated from college, you guys know that. And I really did not expect to have so many views on my videos, but then again we got 1200 people in our college, so it was kind of expected. Um, then again, I'm pretty happy that out of 1200,000 people did see my video, which is a lot. Um, and it was the exam time, so I was kind of thinking that that would be the case, but I never expected it from my heart. Anyway, so I wanted to keep on posting videos as in content on my channel, um, and I wanted to do a lot more than just posting videos about exams. And those contents will be there. I will be posting videos on business analytics 1, business analytics 2, as well as other advanced concepts. Let's say a subject called financial econometrics, a subject called quantitative modeling with SAS, financial analytics, and my perspectives on those subjects. So today's video was dedicated to a topic called dividend stocks, and why I decided to take this video is because it's an easy topic, but it's a very innovative and intellectual topic. It's something which you really would enjoy learning about. And why I say this is because dividend stocks have a lot going behind them. Behavioral finance is a part of it. There's a lot of analytics going behind it. There's a lot of business decisions going behind it. So let's just start by describing what a dividend stock is. Well, a dividend stock is a stock which keeps on giving you dividends regularly. As in, it's not a stock which just gives you dividend once. It keeps on giving you dividends regularly. Now, why would a company do that? Well, that's a very important question to answer. The answer to that is that if a company is continuously giving you dividends, it's essentially saying that we are giving this money back to our shareholders because we do not have running projects. We are not growing supernormally. We are growing stably, and therefore, if we are earning profits 100%, then out of that 100% we would like to give 60%, 20%, 30% as dividend back to our shareholders, because that amount of money will be of no benefit if we keep it with us. As in, it will not be beneficial if we keep that money lying with us, rather give it back to our shareholders so that they are happy. So dividend stocks are important, as in they are stocks which give you income again and again, at a regular interval, so yearly or maybe quarterly. And these are stocks which are essentially invested in because they are regularly income based. What I mean by that is, people who are interested in getting regular incomes back are not risk friendly, as in they are risk averse. They would not want to go for capital gains. They don't want to purchase stocks today and sell it tomorrow, or maybe purchase it now and sell it 5 minutes later, or even a smaller window of time. They don't want capital gains. They want a regular income. And who would buy these? A very, very risk cautious people, risk averse people. Well, it does not mean that just risk averse people buy these shares. A lot of financial institutions, institutional investors also buy these shares. They do it just to diversify their portfolio so that they don't find a loss everywhere, and it's good to have some form of income guaranteed to you, and that is why these institutions also invest in them. But primarily the reason why you would go for these kind of shares is that you want a continuous income in your portfolio, and therefore it's best to go with a share which gives you that kind of dividend. So why do people invest in these stocks? We've talked about risk averseness, but then again, there are a lot of people who look after a concept called dividend compounding. Now, what is the idea behind that? Well, dividend compounding is nothing but you getting back your dividends, but then you're investing the same dividends back into the same shares. So essentially, you get an opportunity to purchase much more amount of shares so that you can get back dividends much more, and again invest those dividends back for more purchases of shares, and you can get back much more dividends. So you're essentially compounding your dividends again and again to buy the shares of the same company so that you can get back much more dividends. And at some point of the time, you can exit the market a lot of money. You've sold the initial investment, you've got some dividend along with it, and you've practically waited for a long period of time and earned much more than what you would have earned in a savings bank account or a fixed deposit account. There's a concept called dividend reinvestment plans also. So what are dividend reinvestment plans? Well, dividend reinvestment plans are plans which are offered by companies to the shareholders who want to, compound their dividends again and again. Now these are plans available across the market, across companies, and therefore one person who's looking at dividend stocks, who's looking to invest in dividend stocks and get a regular income, can definitely offer dividend reinvestment plans. Now, what are the avenues through which you can buy dividend reinvestment plans? Well, you can go for a mutual fund which invests in dividend reinvestment plans. So there are a lot of organizations which there are a lot of mutual funds which are not growth plans, they are dividend plans, and therefore you can obviously opt for that kind of a mutual fund. You can go for exchange traded funds. So exchange traded funds exchanges indices which are investing in dividend stocks can also be invested in, and you can definitely go and purchase from the exchange by yourself. You can just invest in stocks, singular stocks, rather than purchasing a whole package of stocks which a mutual fund does for you. And finally, you can also go for these dividend reinvestment plans and just go for one stock on their own website. Don't go to an exchange, just go to their own website and purchase the stocks. Well, what are some companies that are doing well in the dividend perspective, as in those are companies in India which are looked for a dividend investment? Well, some of these dividend stocks are Ingersoll Rand. If you look at it, the latest price of that stock is 523, and the latest dividend percentage is 2080%. That means you're essentially distributing a whole amount of dividend which you had, kept back from your shareholders and giving it away at the same time. That means that the company does not have some kind of project, it does not have a growth estimate in the short run, and therefore it has given away a lot of dividend. And if we look at the dividends it has been paying from March 14th to March 17, as in 2014 to 2017, it has been a steady 60% of the profits. That means that consistently it has been investing 40% of its profits back into the business. And this time around in 18 they decided, let's just invest a lot more of our profits, as in give away whatever dividend was due to our shareholders at the same time. So essentially it has held back at least 5 years of dividend and paid it at once. ILNFS, okay, that's a very poor stock, but then again it has been considered as something which is a dividend stock, so it has been paying 60 percentage of its dividends. There are another huge array of companies which do fall in the dividend stock bracket. So again, why is it important for us to learn about dividend stocks? It's because if you talk about analytics, you can predict the actual amount that will be paid as dividend looking at historical data. So that's the analytics part of it. You can predict the quantum of the dividend, the percentage of the dividend. You can also predict the time at which the dividend will be paid. So whether it's a quarterly dividend or it's a yearly dividend, that can be prophesized as well using analytics. I think that video will sum up most of what a dividend stock is about, and I hope this video was informative. What we'll essentially do after this video is that we'll create videos on the risk and return. We'll analyze the beta of a stock. We'll analyze how a dividend stock functions in the market, how does it perform with respect to the market. We're also going to find out and predict what the amount will be in the next time around, looking at previous prices. So we might do a time series analysis, or we might do a different analysis. So if you're talking about the amount of the dividend paid, we are going to do a multiple regression. If you're going to talk about the whether a dividend is going to be paid next year or not, we're going to do a logistic regression. And if it does manage to skip it, will it be paying the full amount, the full extent due to its clients? uh, due to its shareholders, at the same time using some kind of an analytics tool. Again, I hope this video was informative.